Chapter 18, Real Estate Taxes. First of all, ad valorem. Ad valorem means according to value. And ad valorem can be attached to anything, but we also attach ad valorem taxes to real estate. And the way this works is when the property appraiser comes out, they assess your property. It's supposed to be based on just value. In other words, what is fair in the marketplace. And when we look at the different types of properties that are out there, there's going to be a lot of taxation going on real estate. Just keep in mind that Florida does not have personal income taxes, but we do have real estate taxes. Now, before I get into anything, I want you to understand that if you don't like your tax assessment, you can challenge that. And you've got 25 days to make that challenge. Otherwise, that tax bill is going to come out November 1st of each year, and you're going to have till April 1st of the next year to pay for it. Let's talk about some of those properties, however, that don't pay taxes. First of all, properties that are immune. And let me tell you what those properties are that are immune. All government properties don't pay taxes. All government properties don't exist, actually. At least they don't show up on the tax rolls. And that's why we say that they are totally immune. The properties that exist do show up on the tax roll, and these are corporations, not-for-profits, and charity-type organizations, and also churches. Now, the way that works is that they show up on the tax rolls, but they are fully exempt from any taxes because of their status. Now, as far as us and our homestead, the state of Florida, remember we talked about this, has homestead exemption. Well, how does that affect our real estate taxes? Let's talk about the homestead exemption. Florida has homestead exemptions for properties that we live in. Now, first of all, let me say this, that there are 3 taxing districts that we deal with. We deal with the city, the county, and the school board. Those are the major districts. Now, are there other districts? Yes, there are. But those are your 3 major districts of taxing. And so with the homestead exemption, here's what you need to remember. The first $25,000 of the assessed value is fully exempt from all taxes. The amount that's assessed from $50,000 to $75,000 is going to be exempt except for the school district. So we have a special taxing exemption based on our homestead. We get 1 homestead and that's it. We can't have more than 1 homestead. Now, when you file for your homestead, there are a lot of other exemptions that we may get. For instance, there are $500 exemption if you're a widow or widower. There's a $500 exemption if you're considered to be legally blind. If you're military related, if you're 10% or better, there's a $5,000 exemption that you get. But now, if you're 100% military disabled, you don't pay taxes on your homesteaded property. There are greenbelt laws also, and let me tell you what greenbelt laws are. These are agricultural properties, and they're mainly in the outlying areas of a community. And these greenbelt areas, the reason that they have a lower assessed value, the tax rate doesn't change. They're simply assessed lower, and probably the reason they're done is because they have less of a use for them. In other words, a lot of your agricultural properties, you can build 1 home on 5 acres or 1 home on 10 acres. So it diminishes the value because of that. And what happens is that because of the lower assessed value, the agricultural properties pay less taxes. Now, as far as calculating our taxable value, remember what we have to do is we take our assessed value minus our exemptions, then that's going to give us our taxable value. And just remember that our taxable value, whatever that is going to be based on a millage rate. Remember, a mill is 1/1000th. And when you look at the various districts, your school district, your county, and your city, we add all of those up. Now, I'm going to forewarn you on test questions. They may say that a property is located in the county. Well, if it's located in the county, that means they're implying that it's not located in a city. That means you only have county and school taxes. But if they don't mention anything, you've got to assume they're located in all 3 districts. And all you're going to do is you're going to take your assessed value minus whatever those exemptions are is going to give you your taxable value. Then you apply the millage to it. Special assessments are typically government issued. And let me tell you what we're talking about. A special assessment can be levied against a property because maybe the government paved the street in front of your house, or maybe they put in lights in your community, or maybe they put a sidewalk in. I'm not talking about condominiums or things of that nature. I'm talking about government special assessments. And the way this works, you're going to have a test question on this. The way this works is it's going to cost a certain amount of money for that amount of, let's say, street or sidewalk in front of your house. They're going to give you a number. They're going to say that your lot is 120 by 300. Always remember the 120 is the road frontage. You don't care about that other number. And so when they tell you that you're going to have to pay a certain amount of money based on your road frontage, here's how it's going to work. The city or government is going to pay a certain percent of that, and that means that the homeowners will pay the remaining portion. But one critical component of this, the state assumes that somebody owns the property across the street from you. Whatever that bill is in front of your house is going to be shared by the party across the street. So whatever that bill is in front of your house, simply divide it by 2 because you're sharing it with somebody else. The non-payment of property taxes can cause you problems. Remember that your bill comes out November 1st. In fact, you get a discount if you go ahead and pay it November 1st. But if you don't have it paid by April 1st, it's delinquent at that point. That means you got through March 31st to pay your tax bill in the next year. If you fail not to pay it April 1st and it becomes delinquent, then they're going to gear up to have an auction. And what they're basically going to do is they're going to sell a tax certificate. Somebody's going to step up and pay your tax bill for you. That bidding starts at 18% interest and works down. And it's going to go to the lowest bidder. Whoever bids on it pays your taxes for you. Now, they can't do anything with that tax certificate for 2 years. But at the 2-year mark, at that point, now they can say either pay me plus interest, or I'm going to send this to the county or the city, and I'm going to have a tax deed issued. And all they're doing is they're going to take the property, send it to the government that's in charge of it, and they're going to force a sale, selling the property for the taxes that's owed plus the interest accrued on that bill. So whoever holds that tax certificate is going to get their money back at that public auction. Now remember this also, that you cannot hold a tax certificate for more than 7 years. If you do, it's going to expire. There are federal income tax laws that you need to be familiar with also. I think the biggest one has to do with the sale of your primary residence. Now, this is a federal statute, not a state statute. So we say that primary residence is probably going to be your homestead. In those states that don't have homestead, it doesn't matter. It's still your primary residence. And what it basically says is that if you're married filing jointly, and if you have a gain of up to $500,000, that amount of gain up to $500,000 is not taxable. If you're filing separately or you're an individual, you have a gain of up to $250,000 that is not taxable. So that's a great benefit in home ownership. That's your primary residence. Now, there are some other benefits we have. We can deduct our interest from our mortgage. We can deduct property taxes. There's a lot of things that we can deduct that's also a benefit of home ownership. I want to talk to you now about how do we calculate taxable income. Because from an investment standpoint, you're going to need to know how to do this. To calculate your taxable income, first thing you're going to do is take your net operating income. Remember, we talked about that earlier. To get to your net income, you take your effective gross income, minus your fixed expenses, minus your variable expenses, and minus your reserves. That gives you net income. Now, the deal is this. Reserves are set aside to pay for things that break. But what if you don't spend that money? It's taxable. so you have to take it and pay taxes on it. So to pay our taxable income, we got our NOI, we add our reserves back into it, and there's two deductions that we get that's important. We get to deduct the interest on our mortgage that we paid, and we also have a process called cost recovery. We get to recover the cost of the improvement over time. Some people call that depreciation. Those are the two things that we can deduct from our net income that's going to give us our taxable income. And from our taxable income, we apply our tax rate, and that gives us our income taxes. Now, how do we avoid paying taxes? Well, you can't really avoid paying taxes necessarily, but you might be able to put off that tax consequence to a later date. And there's two methods of doing it. One is an installment sale. That installment sale is called seller financing. And let me tell you what seller financing is. You're simply, as a seller, saying you can pay me later in payments. Well, the good news about that is that if you have a $300,000 gain, if you take it all at closing, you're going to pay taxes on it. But what if you took that $300,000 gain over 10 years? That means you'd be collecting $30,000 each year. You only pay taxes on gain that you collect in that particular tax year. So that means you're putting off your tax consequence over time. Another way that you can delay taxes is through a 1031 tax deferred exchange. And all you're doing is you're exchanging like-kind properties. Now let me define that for you. Anything that you bought for income, business, or investment could be a like-kind property. And there's two exclusions. Your primary resident can't be exchanged, and dealer inventory cannot be exchanged. And all dealer inventory are properties that a builder or developer has built for resale. Can't use those in exchange. So those are things that we can do to delay our tax consequence. And that's all I have for Chapter 18's real estate taxes. What I'd like to do right now, let's review it. Chapter 18 review, real estate taxes. Ad valorem taxes are real estate taxes based on millage rates. Government properties are immune from taxation. Churches and nonprofits are exempt. The homestead is partially exempt. Greenbelt laws favor agricultural properties with a lower assessed value. Non-payment of property taxes causes a tax certificate sale. Bidding starts at 18% and bids down. After 2 years, the holder of the certificate can request a tax deed through a foreclosure. A primary resident lived in 2 years out of the last 5 years has a special capital gains treatment. $500,000 of gain if you're married filing jointly, or $250,000 gain if you're filing individually. Taxable income is calculated by taking net operating income plus reserves minus interest minus depreciation, which is also called cost recovery, and that'll give you your taxable income. Like-kind exchanges and installment sales can defer taxes to a later date. And that's all I have for Chapter 18's review.